a trainer where I travel around the country doing soft skills seminars in rooms for a client.
Wow, awesome. Well, thank you for being here
Okay.
today. We're very happy to
I,
have you.
sorry, I got it going. So I'm gonna go ahead and well, the live has started, but I'm gonna go ahead and
Share the
pull up the
screen.
presentation. Yes, that part.
Okay. I'm gonna help her with her words today. We're
Apparently. While I struggle bus along. Okay. Share screen. This screen. Share. Hold on. Okie
almost
dokie.
there.
There we go. Now you should see it.
Well, Jay, you're in the right place. And those of you who are on the live, you're in the right place. We're going to talk today about the lender's edge. So those who are in real estate or banking or lending of any sort, we're going to talk directly to you on how we can help improve what you're doing. My name's Alicia Alt. I oftentimes go by Allie, so I confuse people. People also call me Alicia, Ali. I kind of will respond to any name. But I've been in this industry for a little over 20 years. August will be 21 years. And I worked in different capacities of the industry of like lending and credit repair and real estate and all of that. So I bring a wealth of information in that respect. So please feel free to ask me questions. I might know the answer, but I promise you, if I don't, I won't lie to you. And Ivory and I joined forces together not too long ago to create a really cool AI software called Credit Score Pro. So we will talk about that today and how that can help you in your industry. But I'm going to hand it over to her and let Ivory introduce herself.
Hello, everyone. My name's Ivory Becker. If you haven't attended one of our events before, I'll share a little bit about myself. I'll be quick though. Background is in regulatory compliance in the default side of things, dealing with the financial crisis. Was in that side of the industry for quite a while, and then went to financial planning, and here we are. I went back to the credit space. That's where my home is and where I'm very passionate. Allie and I came together with our shared passion of understanding credit, teaching others about credit, helping people manage credit effectively. Just as we all know, there's really a big lack of focus on credit in financial services, even though it is a foundational aspect of pretty much every type of approval for any lending product. So as somebody who is on the side where you're speaking with consumers go to you as that advisor, as that trusted professional, it's really important to understand the how credit works, right? At least the basics. And then if you can build off the basics, you can really set yourself apart from your peers. So we're here to help you do exactly that. And that's a perfect segue. So we want to make sure you understand the options you have so you can have an edge in today's market. um, we've seen a big transition in the market, and I don't really need to tell you much about that because you're living it in your day-to-day lives. So we want to make sure you can capitalize on any type of client that comes your way, especially when clients are fewer and far between. And then we also want you to understand how credit works, what credit options are available, and what solutions you have available that you may not be aware of. And some of it may even just be perspective shifts, and that can help you with any of your clients that have credit trouble. So, what is the problem for lending professionals? And I think we've spoken a little bit to that between Allie and I so far, but if we really break it down, if we look at the data we have a lot more data on the mortgage side specifically. So if we look at that average consumer that is inquiring for to get a mortgage. So at about 69,000 consumers, only just under 25,000 actually close on a mortgage. So that's a loss of 65% of applicants. Now, from those who actually submit that application to closing, we see the main reason preventing them from closing is credit history and debt to income ratio. So it's about 53, 54% of the decline reasons. A lot of times we think we have little to no control over this category as that trusted advisor, but we're here to show you where you do have some control. So, and I know this data is old. I'm waiting for my new data, but I haven't got it yet. They're not quick at giving it
I
to
would
me.
say that even though this data you're getting sourced from 2020, I would suspect that we would see a very similar, if not more of
Higher.
credit history and the debt to income ratio being a bigger problem with denials rather than the other way
Yeah.
around. Mhm.
I would agree with that. I'm guessing it's probably increased with what's going on in today's market, right?
Yes.
At today's market, we have higher debt to income ratios, lower credit scores, less savings for consumers because they've had to use their savings to live on, and a lot more consumer debt. A lot more consumer debt. So we've been seeing a steady increase in utilization on credit cards. We've been seeing a higher delinquency rate on credit cards and really all types of debt for the most part. I don't know if there's anything that you want to go into or add to this category, Allie. I know in some of our other lives we really dive deep into these actual statistics.
No, I think this is great. I like the high level. We have a problem. I mean, that's what we're highlighting here, right? This is the problem. And if we're in the industry and we're trying to get a consumer a loan or some kind of lending product, we have to fix these problems. And so our idea today is let's establish the problem, make sure we're all clear about the problem, and then we're going to talk mostly about the solution.
And buying a home is the first step to building wealth for most Americans.
Oh, wait a minute. Can you repeat that? Because this,
Oh,
I
you
think
scared me.
I'm so sorry. This, I think, is so, so important. And I really, really don't think that people believe this or really think about this. But buying a home is truly, for a lot of people, myself included, I have a great story. I won't say it
Yeah, I
today.
wanted you to. Yeah, go into it. I think you should.
Okay, buying a home is truly a first step for most people in building wealth. That's a fact. And my own story will tell you this. I came from a very low income family, and I didn't have any resources, any of that type of thing. I bought my first home at, I believe I was 23. So I was, yeah, 23, I believe. First home at 23. I lived in it for a while with my two kids. I sold it, made a really good profit off of that, took that profit, bought a much bigger home, did some rehab work, Jay, like what you do.
Yep.
Did some rehab work, made a really big profit when I sold that property, was able to buy 2 gyms and a new home with that. And then later sold those 2 gyms in that home and now live in one of my dream homes in Florida. So I could not have saved that money, that amount of money, or work that hard to come up with the funds that I came up with in a very short period of time had it not been for the very first home I bought and then the subsequent homes after that. So I can't stress this enough. When people talk about they want to fix their credit, this is why. Fix your credit. It is your journey to wealth. And for most people, that is the case because they're not coming from wealth.
And I think you've already explained the why behind this, but statistically, households who are homeowners have 43 times more wealth than households who rent.
Yes.
So I'm just let that sink in. I think that's a crazy statistic.
It is.
So, what is the opportunity we have here? 19 million adults lack a credit score. 37% of adults have a credit score below 700, and 16% of adults have a credit score below 579. Why are these numbers important? These are the people right now that are looking for homes because they're the ones that everybody was overlooking and not giving attention to when the market was going crazy, right? When the rates were very low, under 4%. We're just going to generalize it that way, under 4%, right? If you were 579 and you went to a mortgage lender and they have a line of people out the door wanting their attention who are that 700 plus range, great debt to income, they're not going to get any help to get their scores up, right? These are the
Nope.
people now that we have time to help now as loan officers, right? So, who's knocking on the door right now? These individuals. And if you don't have the resources to or the answers to help these individuals, you're missing out on so much opportunity and so much success that you could have,
Yeah.
which is why you're here, right?
These are typically the people too who are not rate sensitive. You know, they're used to, unfortunately, let me say that, they're used to paying the higher prices. I mean, I've seen car interest rates at 20 and 30% interest. They're paying that because they have to, because they have bad credit, but they're paying that. So if they're going to go buy a home and need to get a loan and the loan officer says it's 7.5%, they're okay with that. That
Mhm.
700 plus score borrower though is like, wait a minute, I'm gonna wait till the rates get back down to 4% before I make a move, right? So
Mhm.
when we say these are the people out there buying and doing things right now, that's what it is. This is the opportunity to scale your business and grow your business and really become a hero to them as well.
Yeah, absolutely. Absolutely. And there's more of these people out there looking than the higher credit scores because they're going to sit with their 3%, 4%, 2.5%, whatever they have interest rates. They're going to sit with them. They're not going to, there's no reason for them to leave, right? And so those optimal scores, they're not out in the market right now. Your competitors are searching for those people with the perfect profile. They're fewer and far between. There's a lot more of you than there are people with that profile. So there's a really big pool of untapped potential. I think that's really the best way to put it.
Yeah.
So that 22% is what everyone's ideally going after, and only 1.2% of adults have a perfect credit score of the 850, and they tend to be those older individuals who on average stay in their homes for 10 plus years, and typically they stay in their homes till they downsize to their final home, if you will, which typically retirement communities, things of that sort. Okay. Oh, yeah. Also, people aren't really refinancing right now. Let's be real. That's really all that is. That's about.
I've seen a couple situations where they are, again, we're still talking about the lower score people
Mhm.
because they're trying to tap out.
Consolidate.
Yeah, they're trying to tap out of equity out of their home so they can get out of debt right now. So I am seeing that. But then we're also, again, we're talking about those lower credit score borrowers again.
Right, right, exactly. Because they can't get the HELOCs because their scores are not high enough. Okay, so problem for loan officers, we discussed that, but what's the problem for consumers? It's similar. There's no lesson on credit, and there's absolutely no lesson on home buying, right? They come to you and they're like, I want to buy a home. This is all I know. That's as far as I've gone. I don't know how mortgages work. I don't know how property taxes work. I don't know how my credit works. And you're lucky if they understand how to budget, right? And how often are you hearing, well, I can't buy right now because of my credit? What are you saying when those conversations are starting? Some people freeze, some loan officers freeze because they don't have the answers, and they also, it can be embarrassing. Like you feel like you're that professional who should have the solutions and the answers, but you don't. And what do? And you don't want to say the wrong thing, right? That can be very stressful, but you can turn this into a relationship. And these individuals that you end up helping in this category, they end up being really, really good referral sources. And they're not just referring you people that have bad credit, right? They're referring you everybody they know. It's not like they're having a conversation with someone that says, is your credit bad? Oh, if it's not bad, you can't work with them. You can only have bad credit, right? So I don't know
Yeah.
if there's anything you want to add here, Allie.
I like the little thing. A realtor would never let someone's estimate stop them, right?
Mm-hmm.
And I think as a lender, if you're a lender, you shouldn't let the credit score stop. We should be building those relationships. People are coming more so than any other time in our history, I believe. Consumers are coming to professionals, loan officers, bankers, financial advisors, all they're looking for a trusted advisor. When I say the word trusted advisor, what I mean by that is that you can answer the credit questions, you can answer the financial questions, you can answer and or have the appropriate resource available to for them to find those answers. And
Mm-hmm.
that's a lost art. Like people don't do that anymore. And that's really what we need to do. People are searching for more value for their money than any other time. And I think a lot of that's due to technology, right? Technology's taken over a lot of places. So if they want human interaction, they want very valuable human interaction, right? For their money.
Absolutely. Absolutely. And when you are helping someone to improve their family situation, I mean, they're not going to forget that, right? You probably have a repeat client. Okay. So let's talk about understanding credit score. So we're going to shift gears a little bit. We want to Allie and I are going to dive into these main factors that contribute to the credit score. We're probably going to talk about a couple things you may not have heard of before, but that are important to understand. And then we're going to build off of this and start discussing after this the difference in credit score algorithms, right? So we want to start with the foundation first of how does the credit score itself work. So there are 5 primary factors that determine your credit score. And the credit score, what's important to understand is the credit score is for the lender, right? It's for the lender to understand how much risk they are taking on by allowing that consumer to borrow from them, right? Sometimes I think we personalize the credit score so much and we think that it's about us, right? But it's really just data. That's all it is, data for a lender to make a financial decision. So that credit score itself, the number you see is a rating of credit worthiness. So that's a common term you'll hear when talking about credit is your credit worthiness. So how do we improve that credit worthiness? So I guess we can start from the top, I suppose. The most important factor to the credit score worth the most percentage points at 35% is payment history. So this is looking at positive payment history and negative payment history. Do you pay your accounts on time? And so as a reminder, the items that report to the credit report are going to be debt, right? If you want other types of accounts to report, you have to proactively add them to your report. But this is primarily and mostly just looking at the debt. So do you pay your accounts on time? And if you don't, once you go 30 days delinquent, you're going to see points taken off of your credit score. And the more severe that delinquency, the more severe the point drop. Anything you want to add on payment history, Allie? I think we'll end up touching on some points in some of the other categories.
No, you're good.
Okay, so amounts owed. That's 30% of the credit score. So another way to look at this is utilization ratio. So this is looking at, I want to zero in and focus first on revolving debt, so specifically credit cards. So we're looking at what is the balance versus the credit limit. So something that's really important to understand is it's all about ratios, not the dollars. What I mean by that is if you owe, let's say you have a $500 credit card, the credit limit's $500 and you owe $500. You have 100% utilization, right? It's maxed out. If you have a $5,000 credit card and you've used that full credit limit of $5,000, that's also maxed out at 100%. Those are equally harming your credit, right? Because they're both maxed out. So it's all about that ratio. So your credit score is going to look at each individual card and calculate that into your score. And then it's also going to look at your overall utilization between all your accounts. So your balance on all your accounts versus the credit limit on all your accounts. So there's 2 different calculations it's doing there. So if you're talking with a client and they're asking you, well, how should I approach paying down my credit cards? What's the most effective way to pay my credit cards to boost my credit score? They're going to start with the lowest credit limit first, right? Because again, it's all about those ratios. So I would start in my example with the $500 credit card versus that $5,000 credit card, because we're going to see the biggest boost the quickest, because it's a lot easier to pay off or pay down $500 versus $5,000. So another thing to know about utilization. It's primarily focused on those revolving accounts. So paying off a loan is not going to positively help the credit score. So if we're taking a credit-centric approach to paying down debt, we're going to focus on those credit cards first and not touch those loans. And that's actually going to bring me to length of credit history. If we close that loan, that's going to impact the average age of open accounts on your credit report, because once you pay off a loan and it closes, it no longer helps your credit score. So only open and active accounts help your credit score. So that's another reason why we like to focus on those credit cards as well, because once you pay those down or pay those off, they're not going to hurt your score. They're only going to help your score, right? Length of credit history, like I said, that's just focused on the open and active accounts. So those credit cards, keeping them open for a really long time, that's going to be the way you add longevity to your credit file. So you can keep that average age really long. Loans, obviously, you're going to pay off, and then that's it. They're done. What else did I want to say about length of credit history? Am I missing anything, Allie?
No, you did a great job.
Okay, thank you for the encouragement. Love it.
Rah, rah, rah. Keep going.
Okay, so types of credit use. We'll move on to that, the orange section here. So this is looking at what is your ability to pay different types of accounts effectively. So the more variety on your credit report, the more you are rewarded. So somebody who doesn't have any credit cards, well, let's talk about that. They are now not positively impacting utilization. I have no credit card, so I'm just missing out on 30% of what makes my score. That's crazy, right? They're not getting the positive payment history month after month from having a credit card. They're not getting age, and they're not getting the benefit of variety. So it is not possible to have a very, very strong credit score without a credit card. Plain and simple. You have to have a credit card. Ideally, we like to see about 3 active credit cards, 2 to 3. When you're starting in your journey, I say 2. As you become more mature in your credit, 3 is ideal. So yeah, take that for what it is. It's very helpful to have a credit card. And Allie, how many times should I be using my credit card? What's that magic number we should be advising our clients?
So we want to be using it on a regular basis so that we can show that we have activity on it, but we definitely don't want to go more than 3 months of not using it. So what I would recommend on credit cards is to put something on it that you're buying and paying for every month anyway, and set that up to be paid on your credit card instead of, say, your checking account.
Like your Netflix.
Yeah, like your Netflix, and then have your checking account and just pay off your credit card. So we're not saying have credit card and have debt. I mean, you certainly can do it to where you're not adding additional debt to it, put the card away, but have some automated things on there that you're already spending money on, and then just instead of, like I said, instead of having the checking account pay it off, have your credit card do it, and then your checking account pays off your credit card. And just let that automate itself, and you can put those credit cards away and not be in a situation where you're swiping it and using too much, and then you're affecting that 30% area of utilization, which is important that you that you look at, because that's 30% of your score there.
Yeah, and I think one of the keys Allie is mentioning is if you do not use your credit card, it does not factor into your score. It becomes stale. Remember, credit score is meant to determine risk, credit worthiness. Without good data, it ignores the data, right? That's why closed accounts don't factor in. A closed account can't predict what my account I paid on 2 years ago and closed 2 years ago can't accurately predict what I'm going to do or what my behaviors are going to be in the next 12 to 24 months, right? So it wants to see open and active accounts, right? It's meant to predict forward looking. So that is why that credit cards must be active within 3 months. Otherwise, they don't factor. Okay, so that's types of credit used. And then lastly, we have new credit inquiries. This is really basically the only thing I like to think of this category as. It's 10%. It's not worth a ton. It's like the red flag indicator. So when you apply for debt, that can be a red flag that you're having financial hardship, because sometimes people apply for debt when they need money. Not necessarily money to buy a house or whatever. It could mean they're in financial trouble. And so they're trying to get a whole bunch of debt to save themselves. So it's just like a red flag indicator, right? So what if you went to 3 lending institutions, you don't tell them that you did applications with the other one, and all of a sudden you get 3 loans and you could only truly afford 1 loan, right? So it's meant to really just be this indicator. So yes, you do see a drop in your score because of inquiries. It's very minor. Typically, your score is able to recover within about 30 days unless you're going crazy. And then you will see, once you open new debt, typically you'll see, the way I like to think about it is the credit score algorithm is kind of holding its breath and saying, are you going to make your payment on time? Okay. I see a payment. We can relax a little. I see another payment on time. Okay. So as it ages, it helps your profile more and more and more. So Those are the 5 factors at a high level, hopefully with a little bit of nuggets that you may not have been aware of that are helpful in advising your clients in their behaviors. So again, I guess I would summarize, do not tell them to pay off their loans right before closing. If they need to pay off a loan to help debt to income ratio, it needs to be part of closing or after closing, okay? After you solidify the credit's approved, you're far enough in the loan process, you don't need to pull credit again. What else? Credit cards, don't not use them at all. Double negative there. Keep them active, keep the low balances, and then you want to pay off the lowest credit limits first. So I think that's a decent summary.
Mhm.
Great job.
Love the encouragement. You're always encouraging me, Allie.
Maybe like a chime or a blowhorn or oh, I need one of those party horn things, right?
The kazoos? Oh, no,
Is that
not
what-
those.
No, the
Not
one
the
that has a
kazoo.
little curly thing that comes
I know
in.
what you mean. I have no idea what that's called.
That's what I need to do when you're doing such a great job.
So ridiculous.
All right.
You want to
so
talk about this one?
We're going to go into this one a little bit. Yeah, because I think it's so important. We talked about being a trusted advisor in the industry. It's so, so important.
Mhm.
And one way to be a trusted advisor is to know the difference between a FICO score and a Vantage score. And we're going to go into a little bit of this, but really high level. Vantage is Credit Karma, guys. Okay. So when a consumer comes to you and you pull their credit score for a mortgage and it is 600, let's say, but they tell you they went to Credit Karma and it was 700, you need to know why. Okay. You need to know why this is different. They are two different models. They are still reading the same report. They're just calculating the score differently. Okay. I like to tell mortgage loan officers and people in the lending industry that FICO, the mortgage FICO is using an old outdated system called FICO 5, 4, and 2. I'll just put it simply like that. And it's what I call the mean one, just label the mean one. And their scores are going to be different, but they cannot go to a different mortgage lender and get a better score because all lenders are using the same FICO algorithm for mortgage lending. I've heard clients tell loan officers, well, I'm just going to go to someone else because you got the wrong score. Credit Karma told me 700, Credit Karma is not a lending score.
Right.
It is a consumer score. So that's just high level. I think it's really important you know that because a lot of industry professionals don't, and then they get caught up on that question and wonder, yeah, why? Yeah. So
Yeah, I think that covers that one.
okay.
Okay, so let's talk about some of what we're calling this section, the lender's edge. So how you can have an edge on your competitors and get more prospects.
And
Well,
keep them.
Yeah, I said it a little wrong, but that's fine. So don't assume inquiries are the problem. Number one, we talked about inquiries being 10% of the score, right? Very, 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 very little bit. A lot of times, so what it says is inquiries are rarely the problem. It's usually something else. That something else is usually they closed an account or most commonly credit card utilization changes. That's a pretty common reason we see for the scores to be more volatile, especially if it's someone with limited credit history. If there's less data to go off of, you're going to see more variation, right? If we have more data, we have more cushioning, right? It gives us better guardrails, right? So for someone with a limited profile, I would not assume it's the inquiry. Your client often is going to incorrectly assume it's the inquiry because everyone's terrified of inquiries. So I think that's really the foundational aspect here. The inquiries themselves are usually not the problem. It's usually something else. And you can find out what that something else is most of the time. And then having the collection know-how. So I think it's important to understand what to do if your client has a collection, because we want to focus on, well, what's going to help the credit score we're using, right? We want to know what's going to help the FICO score. Oh, we have a question and I didn't see it. Oh, yeah. Okay, so we want to see what's going to help the FICO score and not the Vantage score. So when it comes to a collection account, A paid collection is going to cause an increase on that Vantage score. If we're not using that same score system in FICO, we're not going to see that same benefit. So you're going to want to see that collection removed from the credit report. Now, Allie, what's our exception with collections? What are the collections we want to pay right away?
So if we pay medical collections by settling them or paying them in full, depending on, if we can settle them, Please don't think you get an advantage by paying them in full. That certainly isn't true. But if you were to settle those or pay them, and they're immediately removed from the credit report. Well, I shouldn't say immediately. It does take some time, but the credit bureaus have a rule where they will remove that from the credit report. So it's a really easy, effective way of improving a person's credit score if they have medical collections. The reason that I like to point that out is because a lot of lenders like to tell people or oftentimes say, well, medical collections don't really are a big deal for us lenders. We don't care about them. And that is true as far as the lending guidelines. We don't care about them, but the credit score indeed does. And if we're trying to improve the credit score on a mortgage credit report, it is very important to pay those medical collections if we can, because we can significantly at times improve that credit score, which could then lower the interest rate and whatever, make the terms better, easier, what have you. But just to restate that, lenders, we don't care that a person has a medical collection, and we shouldn't. But the score algorithm that we use for lending absolutely 100% cares. As a matter of fact, it does not change how big of a weight that is on your credit score versus a medical collection and some other collection. They are weighted the same on the mortgage credit report. So just know that, because I know there's a rumor going around that that's not true. And the opposite is true. And I'm just telling you, I'm telling you the truth right now. Take me for my word.
Listen to Allie.
I'll pound on the desk and get my judge gavel out or something. No, seriously, it could very much help improve the credit score by doing that.
Yeah. And I think it's important to understand the weight of a collection on the report too. If you have somebody who, let's see, the only negative item they have on their report is a collection, depending, my caveat is always going to be, it depends on the report itself and the structure of the report, but it can be up to 100 points that one collection can drop the score. So it may be worth that individual working on credit improvement strategies to see how can we get this collection off the report, because there are ways to do that if it fits the right criteria. And that could create that increase in the score of that 50, 100 points, whatever that is worth.
Can I say something to that first? Yeah. And forgive me if you stated this and I just didn't hear you, but first, we always dispute a negative before we.
I never mentioned that. No, I didn't even go into that.
Yeah. So we talked about, it's great to pay medical collections, but a consumer should always dispute for validation before they ever pay something. Oftentimes, and a lot in the medical spectrum, is that things aren't done right. The insurance wasn't processed right. It was already paid. Or they double billed them for the same service on the same date. That happens often. So there's a lot of things that could have been an error that caused that collection in the first place. And I'm not even just talking about medical collections, right? Any collection. Always challenge that for validity, for chain of title, to make sure the person who's reporting it really does have authority to collect on behalf of the creditor, age. I mean, there's just a plethora of things.
Tons of things.
I do not recommend paying something without challenging it.
Agreed. And we're going to give you options for later, soon. We're going to give you options on what to do about it too with the collection. So
we have a powerful resource and tool.
Oh yeah, it's in the corner here. So, common misconceptions about credit scores. One, we talked about a little bit about this. Checking your credit score lowers your score. It does not lower your score if it's not an inquiry. So what do I mean by that? If you are using credit monitoring, it's not going to lower your credit score. It's not an inquiry. The only time you're going to see an impact to your score is if you're submitting an application for debt. Right? I think that's the easiest way to think about it. Did I submit an application for debt? Okay, my credit's not impacted. It's either from monitoring or it's a soft inquiry. Myth number 2, you only have one credit score. Absolutely not true. We saw that. There's the Vantage credit score, there's the FICO credit score. And then within Vantage and FICO, they have different models, like different iPhone generations, right? The newest and most improved, the latest and greatest model, right? So you have all sorts of different credit scores, and they're all correct. They're all the right scores. They're just used in different ways for different industries. A higher income means a higher credit score. Well, Allie, this is false.
Plus, they don't, your income is not a part of your credit score at all.
And this is why credit can provide opportunity. I think that's something that people often overlook. We look at credit so in such a negative viewpoint, but it can create opportunity for you to change the entire trajectory of your life. And that's what you're doing for your clients. You are changing the whole trajectory of your life, giving them that opportunity to build wealth, to have that 43% times higher wealth than those that rent. Number 4, carrying a balance in a credit card boosts your score. Tell me about that one, Allie. I know you like this one.
You do not need to carry a balance on a credit card to boost your score. That is a myth. You can pay off your credit card every month. I certainly do. I don't like to carry a balance because I don't want to pay interest to the credit card company. However, the reason that that myth is laid out there is because people think that they can pay off a credit card, then not use it. And because they don't want to use it, they don't want to get in debt. Not using it is the issue. We can't calculate a score on an inactive credit card. So we need to be using it consistently, but we do not have to keep a balance on it.
And then the last one, I know a lot of loan officers have seen this. You have a client that comes to you like, I am ready to buy a house now. I just paid off my car. I just paid off my personal loan. I just closed my credit cards. And now I'm ready. My score is going to be perfect. But as we know, when you close your account, it no longer factors into your credit score anymore. So you're going to see a really big drop in your credit score when you close accounts. Especially if you don't have much credit history left that's open, right? The older that account, the more impact that's going to be to your credit score if you close it. That's why we love credit cards for helping the score. Okay, so let's take a look at some of the questions that were submitted from the lovely people that are not here today. So, what is the easiest way to get out of debt, raise the credit score, and be ready to purchase a home? So, we're in an age of one size fits all. I think that's just kind of what we look for. We look for this like miracle solution. And we see it a lot in investments in the insurance world, in the lending space, and here in the credit world as well. Unfortunately, it's kind of a dangerous premise to think that there's one way that works for every single person. So there's a lot of general best practices, but each situation does have its own nuances based on some personal factors, and then the credit report itself too, right? So we touched on some scenarios today, some specific triggers, I guess is the best way to look at it. But I think to summarize, when you're looking at paying off debt, focus on the credit cards first. Work on the smallest credit limit to the highest credit limit. If you can move some of that credit card debt into installment debt, that's going to help the scores as well. And I think that's a really good nugget for you guys that are in the lending space. If you are able to move revolving debt into a personal loan or a debt consolidation loan, that's going to allow that consumer's credit score to improve, right? Because now we're no longer adversely impacting that utilization ratio. So that's just one example, but I think ideally you're just trying to impact each of those categories we looked at in a pointed and purposeful way. I don't know if there's anything you'd add to that one, Allie.
I'm gonna let you wrap that one up.
Okay, great. How fast can you get credit scores up, Allie?
You're gonna throw that one at me?
Yeah, why not? I answered the last one. I rambled on the last one. It's your turn.
You can get credit scores up within 30 days, but note that, when you do something to improve your credit score, it can take time for that to report. So to give you an example, if I told you today your credit utilization on your credit card is really high, I need you to bring that credit utilization down, and you do that today, That doesn't mean that instantaneously your credit score just went up because it reported that new balance. It doesn't work like that. Different entities report on a 30-day cycle, so it could take up to 30 days for us to see that on the credit report. So I like to tell people when they ask me how fast can you help me get my credit scores up, or how fast can the system, you need to give it at least a 30-day period of time after you've made the action steps that are required to do that.
Yeah, and I think it's important to know your credit report, it's updated daily, right? It's all just based on when creditors are sending information, and it's not the same exact day for every single creditor, right? Not every creditor reports on the 26th of every single month, right? There's changes happening to your report all of the time.
Yes.
So, and I think a good segue from this question on how to get your credit scores up fast is the building side. So how do you help clients build credit? So I think it's a little different than working on removing negative information, but building credit is really, I'm going to actually cycle back here a bit. How do we affect these categories? That's what building credit is what can we do to influence these categories as much as possible in a positive way, right? So there's lots of credit building tools that exist out there, and there's some nuances to utilizing them based on what score algorithms being used. And so what I will say, as I get back to the question, what I will say is 2025, when the new version of credit scores are going to be used in mortgage lending, there's going to be more opportunity for utilizing tools that add rent to people's report, the self-reporting of utilities and telecom. All that's going to help you more in the lending space later. But there's still a lot of tools like credit building accounts that allow people to have savings accounts that report like loans on their credit, right? There's all sorts of tools that can be utilized for that consumer. And it's based on looking at, well, where are they not influencing the algorithm currently? And how can we fill in that gap? Or where can we optimize where they're doing okay, but they could be doing great, right? So we may look at the credit card. So I think that's my answer to this question. I don't know if you would add anything to that. So what are your resources, right? We talked about having those resources. You don't have to have all of the answers. It's good to have some of those basic answers that we've provided today. But if you are able to have a resource that you can capitalize on that can give your client the solution. So having the resource that provides the solution is really key. And this is really where Credit Score Pro comes into play. So, Allie, I'll let you take it away here with explaining a little bit more.
Okay, so Credit Score Pro is our solution to all of the problems that we talked about in this webinar. And, we talked about some things that you can do to be a trusted advisor, some information that you can use to empower your clients. But then when you have a resource and a tool to help them, then you got the whole picture, right? It's a holistic thing here. So Credit Score Pro is an AI solution. It is a free resource to your consumers, so they do not pay a fee for Credit Score Pro. However, we do need a credit report to link, so we have something to analyze. So we have partnered with a wonderful company called Smart Credit, and Smart Credit is a credit monitoring. They have a lot of bells and whistles on their own that they provide to consumers. So it's one of my favorite credit monitorings because of all that it does. But with that credit monitoring, you get full access to Credit Score Pro. Credit Score Pro is amazing. Again, AI powered. It's going to do a credit analysis. It's going to do the disputes to the credit bureaus. So it's going to read it, find all the negatives that we talked about that would need to be removed. It's going to do those disputes. The client can do the disputes, but then it goes way above and beyond that. We talked about influencing the 5 factors, and that's where it can create a customized plan for the consumer based on their credit goal. Because remember, there's different credit algorithms for different things that we're doing, right? So we were talking specifically today about the lending one, FICO 542. So the goal is to buy a house. We're going to create action plans from that of what do you need to do in order to buy a house and improve that credit score. Okay. And so it's going to list that out. So it really takes a big weight off of a consumer's shoulders, because now not only do they have a source of getting negative things off their credit report, but now they also have a plan. They know exactly what they need to do to improve their credit above and beyond the disputes. And are you buying a home. Is that what you're telling me?
Yeah, I was just saying, see, this is the goal she was mentioning. I was just trying to get the laser pointer on. I was too slow, okay?
Slow. It says, like, their goal was not to buy a home. There's other goals that they could pick
Yeah.
that would customize a plan for them. But specifically, we're talking today about more the mortgage industry. All right,
Yeah.
so it's spotting and addressing errors with Credit Score Pro. So the client doesn't need to read a credit report and find out what the errors are. Credit Score Pro is going to do that within seconds, and then they're able to use that process to dispute it. So this is where they would click, here's your 16 negative accounts, click on those, pick the suggested reason that Credit Score Pro already provides, because it's a learning system. So it's finding the errors that it would dispute. It's also looking at what's worked in the past. If I disputed it this way to the credit bureaus, what was able to effectively remove that? And so again, it's a learning system and it's able to do that. That's one reason it's so powerful.
Oh, wait, I went too far.
Okay.
Oh, no, we already did that. Okay.
So what can Credit Score Pro actually do? It provides people with the credit scores who have no credit scores. So we can build credit, right? So it will help that. We can improve damaged credit and build strong credit. We identify solutions that mortgage loan officer simulators and rapid rescores can't solve. So a lot of loan officers use something called Wayfinder. There's other tools as well. Those solutions oftentimes don't give accurate actions and or incomplete. My favorite one would be there's no help for this. Okay. And so our actually benefit and are accurate actions for the consumer to do to improve their credit score. And we can help get more loans closed or more buyers. I'm going to let you wrap on this one.
Yeah, so I think there's a lot of things that most people in general, lending or not, don't realize can be removed from credit reports because it's all about compliance. So the great thing about the AI is it's reading that raw data on the back end of the credit file and finding all these possible issues and errors. And there's way more than what I could list on the screen. But I wanted to put a few up there that may be surprising. So it's not about whether someone was past due. It's not about whether someone owed that collection originally or had that charge off. It's about the compliance of the report itself and the activities of the creditor, collection companies, and bureaus, right? That's what the disputing process is all about. So the AI is really good at figuring out what works, like Ali had mentioned, so I won't belabor that more, but we have really high success rates that we're really proud of. And then at the same time, we're looking at all of those factors that make up the credit score. How else can we improve that credit score outside of just working on that negative information? And that's going to be, again, filling in those gaps where they're not influencing the algorithm and then optimizing the good things with a focus on that goal. We want to make sure we're using the right credit score algorithm to put together that action plan based on that financial goal. And so that's what Credit Score Pro does. And the nice thing, too, is it's automatically importing the credit report every single month for the consumer, reminding them to take a look at what's been removed, how their scores have changed. Their action plan renews automatically every month. So it's really as hands-off as it possibly can be, but also interactive in the sense that the client really knows what's going on. They can learn what's causing their score to go up and down. And at the same time, there's a full educational suite in there as well. So they can watch videos about everything credit related, from the basics to more advanced concepts. And a lot of our lenders use that resource for themselves as well. So they can be that advisor, they can have the answer. And, they can also direct their clients, hey, did you check out this video? This is a good video to watch because it's going to explain why inquiries aren't as scary as you thought they were, or whatever. So the whole point is we want to partner with you and help you, one, close more loans. We mentioned that, but spend less time on the unqualified leads, but actually get them to the finish line, right? So how many times do you have that person that's been working on their credit for 1 year? Now it's 2 years. Now it's 3 years, and they never seem to get there. We want to eliminate that from happening. And then we want to make if you are doing lead generation, let's actually make that money go further. How many of those leads you get through lead generation have good credit? Not too many. So the ones that don't have the good credit, you funnel them through this system, and now you still have clients. You're just building your pipeline up for later. You'll have that higher conversion rate. And like that last bullet point mentions, have that pipeline for the future. So when we go through these market cycles, if we're in an up and we go down like we are right now, it doesn't matter. You have that consistency, that baseline consistency that's under there, that's underlying your full pipeline. So lastly, this is our information. We do a live every single Thursday. So every other Thursday is for focused on professionals. And then the opposite Thursday is really targeted towards consumers. If you're a professional, I mean, both are helpful, right? You're going to learn a lot of information regardless. If you want to check out the credit building tools that you can use with your clients, they are available just on creditscorepro.ai, which is our website. Or you, of course, can access Credit Score Pro that way. If you want to be a partner with us as well, we do have an affiliate program which does allow you to see what's going on with your clients that do enroll in Credit Score Pro. So you know what's going on, so you know when they're credit ready. And then beyond that, we have a Facebook group. It's called Credit Score Pro, the AI Credit Revolution. So check us out there, join us, answer consumer questions there. And then follow us on Facebook, all the social medias. We have lots of videos. You can send them to your clients. That way they have the know-how and the knowledge base to not make the mistakes like paying off all their loans before applying. And I already talked about this. Yeah. So yeah, I guess that's it. But I would encourage you to join us again next week. I'm gonna stop the screen share and then let me share with you maybe what our event is next week. It wouldn't let me close the PowerPoint. My goodness. So next week's event, we have and I briefly had mentioned how we will be having a score change coming up, algorithm change coming up in 2025. So stay tuned in July. We're going to have a webinar just focused on that at the end of July. But next Thursday, our event is going to be how AI is revolutionizing credit repair. So this is going to be a deep dive into the AI that we're utilizing. And then the following Thursday, June 6th, it will be why most credit advice you hear is wrong. So those are our next upcoming webinars. If you want to see them all, every single one of them is on Facebook on the Credit Score Pro Facebook page. So with that, I suppose that concludes for today as far as the live goes.
Hey, so we do have Jay with us. I want to make sure, Jay, do you have any questions that maybe we didn't address that might be helpful in what you're doing?
Oh, you're on mute. There we go.
There we go. Okay. No, I've really enjoyed this. It was an eye opener.
Good, good. We're very
Awesome.